Hi, I'm Christine Benz for Morningstar. Are most investors buying total market ETFs and calling it a day, or are more finely tuned ETFs getting their attention? Joining me to discuss the exchange-traded fund landscape is Rich Powers. He's head of ETF product management in Vanguard's portfolio review department. Rich, thank you so much for being here.
Thanks for having me, Christine.
Rich, let's talk about fund flows from Vanguard's perspective. From where we sit at Morningstar, it seems like we're observing most of the assets just going into the big building block total market index trackers. Is that Vanguard's perception as well?
It is. Actually, if you look more broadly in the industry, that tends to be the case. But if you zoomed in on Vanguard's areas of cash flow interest this year, what you're finding is the total market funds, be it VTI, which is the U.S. equity market, or BND, which focuses on U.S. investment-grade bonds, or even BNDX, which focuses on international fixed income. Those have been very popular, along with VU, which tracks the S&P 500. The international fixed income cash flows are kind of interesting in light of the interest rate environment we find ourselves in.
Very low yields, negative yields in some cases.
That's right. And what we take from that is perhaps that investors are starting to appreciate the benefits of diversifying their exposures across different yield curves, so removing some of the home bias that you see in fixed income portfolios.
Okay, so let's get back to this interest in sort of the total market trackers. Do you think let's talk about what's driving it. Is it that advisors are saying, I'm not going to monkey around with large growth, large value, et cetera. I'm just going to get U.S. equity exposure with this single building block? What are the forces that you think are driving the interest in the very basic products?
I think it runs the spectrum. It depends on the investor type that you're talking about. I think there are some advisors who are saying, I don't want to kind of carve up the marketplace. Give me a simplified portfolio, and the totals actually allow them to do that and spend their time on other value-added activities on behalf of their clients. Others might be starting with those products as the core and then complementing them with perhaps a factor strategy or tilting towards corporate bonds, but using that as the core of their portfolio. I think the other thing you can't argue against is cost. And so if you look at the expense ratios for these building block portfolios, they're all low single digits, and in many cases the spreads are a basis point. So the total cost of ownership for these types of products is incredibly low today.
Okay. So speaking of costs, I want to talk about commission-free trading in the ETF space. It seems like all of the barriers have broken down. Are you concerned about the commission-free trading environment maybe stoking investors to trade more than they should?
Yeah, it's really exciting. Actually, the commissions have been reduced across so many different platforms. It's something that we probably started about a year ago when we made commission-free investing available for all ETFs on our platform. I think a concern that folks have articulated is that the lack of a speed bump, the commission, will invite investors to embrace some bad activities, right? So trading a little bit more. We've actually looked at the level of activity on our own platform the year before we went commission-free relative to where we've been the last year or so. And there's been no discernible change in terms of trading activity. On average, an investor is making 6 transactions in ETF, and most of those are actually them adding more to the existing ETF versus them trading from one to another. And so the before and after experience for those who are on our platform tells us that commissions being removed didn't invite them to take on some of those activities that are going to harm their long-term results.
Okay, so another question I'd like to cover with you, and it's a big one, but as we've seen this gusher of flows going to ETFs and in traditional index funds, a question is, at what point will indexing be too large? Are we close yet? Let's get your perspective on that question.
Yeah, I would argue that indexing isn't big enough at this point, be it in a mutual fund or an ETF. If you just looked at the U.S. equity market, index assets, call it about a third of all industry assets are in a passive strategy. If you looked at fixed income, less than 5% of industry assets are in passive fixed income. And so in both cases, active managers represent the vast majority of the assets. And if you zoomed in on trading, the numbers become even more compelling in saying that indexing isn't very large at all. Less than 5% of all trading activity in the market is driven by index equity ETFs. And so this notion that index ETF cash flows or index fund cash flows are harming price discovery, the data simply doesn't prove that out.
Okay. So it sounds like you still think ETFs have room to grow. I'm guessing you do. But let's talk about how, in what other ways you expect that the ETF landscape will look different 5 years from now versus where it is today.
Yeah, I think there's a couple of things that are really interesting around what's going to happen in the ETF industry. We've done some studying of this over the last couple of months as to how do we think the world's going to unfold. I think you'll see more and more investors using ETFs. So we looked at a couple different studies and ETF usage across different client types. Less than 20% of all registered investment advisor assets are in the ETF structure. If you looked at broker dealers, the number is closer to 10%. So this idea that advisors use ETFs almost exclusively in their portfolio construction, a bit of a myth, right? Because only 80%, only 10 or 20% of their portfolio construction is in ETF, so more headroom for them to grow there. And then if you zoomed in on the individual investor, I think they're just getting started in terms of ETF adoption. That less than 10% of individual investors use ETFs in terms of in their portfolios. And so I suspect what we'll see with ETFs is not so much the complexion of the industry evolves, but rather the buying base will be very different.
Okay. So another thing that I've been thinking about is just investors are buying index funds, total market trackers. Performance has been very good, especially if you look at sort of the U.S. total market index. Are you concerned that maybe some investors have unrealistic expectations about the product? Is that something that worries you?
We were less concerned about that. We've been offering index products, be it funds or ETFs, for 40 years now. And what we find is that index investors tend to be much more long-term and more likely to not take action during environments when the market gets bumpy or even market returns are negative. In fact, actually, if you dialed the clock back 10 years ago, one of the great catalysts for greater ETF adoption over that period of time was index funds providing market-like returns while many active managers struggle to deliver there. And so to the extent that there's another challenging market environment, that might actually be a further catalyst for investors looking at index funds or ETFs as a solution.
Okay, Rich, great to get your perspective. Thank you so much for being here.
Thanks for having me.
Thanks for watching. I'm Christine Benz for Morningstar.